Hi, this is Dr. Tom again, and this is our second video in internal controls. And we're going to talk a little bit about cash handling first, and then we're going to cover what is the voucher system, because that's a very important concept and the thing that you'll see in business. So first of all, we want to define cash, and you think, well, what is cash? Well, cash is, of course, those green things. I like to have a lot of them in my wallet, but maybe not. It says here, cash are, of course, currency. That's the green stuff, right? Coins, deposits in bank accounts, customer checks, cashier's checks, certified checks, money orders. All of those are considered cash when we're in the world of accounting, right? And again, we talked a little bit about auditing in the previous video, and auditors keep track of all of these things because guarding them, there's a lot of fraud that takes place, especially in checks. When I was an auditor years ago, we would get a printout every single day of all of the checks that were issued by the bank and what we said was supposed to have been issued by the bank. And there was always discrepancies almost every single day, and we had to figure out what was going on. And many times it was because checks were being fraudulently changed, being made to somebody else when another person was cashing that check. Okay, so just so you know, that's what we're talking about. Now, we did also talk, I'm going to jump over here, and we talked a little bit about the cash drawer. And, you know, people are people. Like I said, maybe you've worked in fast food, you've worked at a store like Target or Walgreens or any of these stores where you're working the register. And what happens is sometimes there's a mistake. It's not necessarily I'm stealing anything or I'm trying to do something illegal. It's just that there was a mistake. So here's a situation, and you'll see this a lot in this, you know, we're talking about Financial Accounting Course 1, where they're taking you through these transactions. I try not to dwell so much on the transactions because that's really for a bigger thing. And if you want me to make videos on transactions, please put it in the comments and let me know. So here's a cash register's receipt. Here's what's happened. So what we're going to look at is when we count the drawer out, how much cash is there? That's the question. And how much did we sell, right? So here what has happened is we made our sales of $550. That's what our register says we sold. And we should have taken in $550 in cash. And what we actually took in, when you count the drawer, there's $555. So we actually took in $5 more than what we actually have in the transactions, which was in the sales transactions, which is $550. So we create what we call an overage account. We call it overage in short because sometimes it's long, like here where we have more, we call that an overage, and sometimes it's short, which is going to be our next slide, of course, right? But it's good to look at this because it really helps you understanding what's going on. We're always going to deposit the cash in the bank, right? So even though our sales said $550, the cash we're putting in the bank is $555. So we have to come up with something to balance this out, because remember, our journals always have to be in balance. So what do? We got this cash over and short account, and you'll see here we got more cash, so the cash goes in the bank account, so that we're not changing cash, right? We're actually adding this account. So sales and the overage, we're crediting the overage and shortage account so that we're in balance. Now let's take a look at the other one. Now you'll see on this particular one, first of all, what was our sales? Our sales was $625, but our cash we collected, now remember, cash could be checks, was actually less. It was $4 less. It was $621. So you'll see here now, we debit the cash over and short account for $4. So you can look at these two transactions. Here, we're crediting because we have more cash, and here we have less cash, so we're debiting the over and shortage account. And this, again, is a tolerance. We don't want this to be too great. And most companies, again, auditors will set a tolerance. If you're off by, out of $625, if you're off by $4 or $5, you know, maybe that's acceptable. In other places, if this was a lot more money, you'd be fired, or they might even call the cops on you. I don't know. So let's go on. Now we want to talk about the voucher system. So imagine now we're in the accounts payable, and we have a whole chapter typically coming up on accounts payable, because that's a whole thing in itself. But we cover it quickly here real quick, because if I'm paying bills, I'm paying something, I need to know that I'm paying correctly. This is part of the internal controls, because having the voucher system makes sure that I'm paying things correctly when I'm using the cash of the company, right? Approving and recording liabilities for eventual cash payments and issuing checks for what's correct. And this goes into a lot of detail, but let me explain this to you. So many times the person, if you're the accountant or the bookkeeper, you're working in a different place, in a different building, maybe in a different country or a different state. You're at the headquarters, and the person that's actually receiving the goods might be, take for example, we talked a lot about, you could talk about Walmart, where their headquarters are in Bentonville, Arkansas, or Target is Minneapolis, right? And so somebody at the headquarters is paying the bill for something that was maybe delivered to a Walmart that is in your hometown, right? Unless you live in Bentonville, Arkansas, then that, kind of makes sense, right? But if you're in, Minnesota, or you're in Iowa or Oklahoma or California or Florida or anywhere else, and you're the guy that's receiving, a guy or girl that's receiving tires for the tire department, for their automotive department, and the tires are coming in, then what you're doing is you're checking to make sure we got the right tires, right? Okay, the receipt says 4 tires or 8 tires, whatever it is, and these are the types, and this is how many we got, and maybe they have what we paid for them on there, maybe they don't, but they're checking in to make sure that we ordered these tires and these are the tires we got. And so that's called the receiving in. And so that's done electronically. The receiver puts it in. Okay, we got the 4 Michelin tires, we got the 4 Goodyear tires, the BF Goodriches, and maybe there was a shortage. Oh, we ordered 4 and we only got 3, or maybe we ordered 4 Michelin and 4 Goodyear, but we got all 8 Goodyears, and things like that happen. But that's the receiver's job, to keep track of all that, and they put it in the system, and that system is connected in the enterprise accounting software system to the person paying the bills, who could be in a completely different place, like I said, a different state or even a different country. And so now this person is paying the bill. They get the bill from the tire company who's delivering the tires, and then they say, okay, well, here's 4 Michelin tires they're billing us for, and they should be, whatever, let's just say $100 a piece. And did we get those 4 tires? So they match, they call it matching. The voucher matches what the person is put in at the receiving place, wherever that's at, and what the bill is, the invoice. And so the invoices all have different numbers, and we go into great depth when we talk about this in the accounts payable module. But one thing to know is there could be what they call a 3-step, a 3-way match. There could be a 4-way match. And again, sophisticated software systems can keep track of all of this stuff. So for example, let's say I'm a big giant company, and I'm saying, well, we're going to order, we're Walmart, and we're going to order, over a period of a year, we're going to order 100,000 Michelin tires, right? And so we're going to have a contract where we put it out to bid, where we're going to get the best price for Michelin tires, right? So the contract is saying we're going to buy 100,000 tires, and we're going to get them for, $50 a piece or whatever, right? Instead of 100 that we would normally pay if we only bought 4. So we're going to get them for 50 because we're buying 100,000 of them. So that's the contract. We're going to say over the next 12 months, we're going to buy 100,000 tires. So now the store needs, okay, well, we need 10 Michelin tires, or we need 8 of them, or we need 16, whatever it is. And then we say we need to have, over here at this store, we need 16 Michelin tires. and that's called the purchase order. It gives the store the idea that these are how many stores we're going to get these 16 tires, right? And then of course, like I said, the receiver is going to check them when they come in against the purchase order, because this store got 16 and another store got 24 and another store only got 4, right, out of these 100,000. So now we're matching the contract to the purchase order, to the receiving, and eventually to the invoice that the person is paying. And so again, when you get it into a sophisticated software system that's a voucher system, it keeps track that, okay, we're supposed to get these tires for $50, not $100, not $75, no other price, because we were supposed to get them for $50. But maybe there was a mistake where somebody says, oh, we're giving you 4 tires over here at this store, and we're charging you $100 each, right? So then the voucher is going to catch that, because it's going to say, or maybe the purchase order was for 24 tires, but we got 4 of them, or we got 16, we didn't get 24, right? So we're missing some. And so this voucher, but the bill says, right, the bill says 24, but we only got 16. So the voucher system checks all of these things to make sure that when the person's paying the bill, no matter where they're at, it matches all of these things. So we're going to talk a little bit more about these this matching system and the voucher in the accounts payable module, but know that the voucher is what it's called when we're keeping track of all this stuff. It's the authorization to make a payment, which means what are we doing? Internal controls. This is about internal controls. We're guarding our money. We're not paying too much for the tires. We're not paying for tires we didn't get. And so that's what this is all about. And so this will be the end of this video, and we'll see you in the next one.